Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. We're in another hotel room video. We haven't done one of these for a little while, so I thought we were due for an update. So today we're going to talk about a theory that is rampant. It's running wild in the investment community. It's widely used by, it's widely taught at least in business schools and used and accepted by professional fund managers, and that is efficient market theory. Also linked in with that is modern portfolio theory, but essentially it goes that all the information about a particular company or about a particular stock is priced into that stock at all times. In other words, it's impossible to buy something for less than it's worth, and it's impossible to sell something for more than it's worth. Rational people wouldn't sell things for less than they're worth, and they wouldn't buy things for more than they're worth. So therefore, everything is priced efficiently. All prices are equal to their values at all times, and you can't beat the market on average, so there's no point in trying. You should buy an index fund, you should forget about it, wake up 30 or 40 years later and be wealthy. And that's, to be fair, that is a strategy that's worked very well over the last century. Index funds have worked, low-cost indexed mutual funds have worked, and on average people have done quite well in the stock market. But when we get to the outliers and the value investors like Warren Buffett, Charlie Munger, Mohnish, Pabrai, these people that have been massively outperforming the stock market for a long time, the academics struggle to explain what's going on there. And I want to walk you through a lecture that Warren Buffett actually did in 1984 called The Super Investors of Graham and Doddsville. Let's get into it. So if you're not already aware, Warren Buffett has compounded money at about 20% a year on average for over half a century now. He's quite an old man and he's still performing very well. So he's had a long time to compound money, and it's one of the reasons that he is consistently one of the richest people on the planet. So what he was originally taught about investing by Ben Graham at Columbia University was to buy securities or buy into investments at significantly less than they are worth, based on the assets that that company has and based on the cash that it produces. So value a business, buy it for less than it's worth, and get a margin of safety through that sort of discount to the actual value. And Burton Malkiel, he is an academic, he's an economist, that came out with a book, quite a popular one actually in the 70s, called A Random Walk Down Wall Street. And he basically came out and said that that just doesn't work anymore. Information is so readily available now that prices are equal to values at all time. And just like there's outliers in any sort of bell curve, Warren Buffett is at the top end of the bell curve and he's lucky. That is basically the argument of the academics that believe efficient market hypothesis and believe modern portfolio theory. So if you've watched any of my videos before, you'll know that I am a value investor. I too look for a margin of safety to the actual value and try to get a bargain in the market. So the academics would be out there saying that I'm trying to do the impossible. It's not possible to get that sort of discount and get those deals. But I'm going to take you through, like I said, The Super Investors of Graham and Doddsville, a lecture that Buffett did in the 80s that explains that this is actually possible, and he provides evidence around the philosophy of these investors and the actual kind of validated records of what investors using a value investing strategy have done. So the way that the academics explain, like I said, is they picture Warren Buffett as an outlier. So they think he's basically a monkey flipping coins, and if you have enough monkeys out there flipping coins, sooner or later you're going to have one that flips 100 heads in a row. And that monkey that flips 100 heads in a row in this example, they're saying is Warren Buffett. So Warren Buffett basically went out there and said, well, okay, I can see where you're coming from. Maybe I am just lucky. Would it still be luck though if all of those monkeys that were flipping 100 heads in a row came from the same zoo? That's essentially what he argued, and he went through and looked at all of the students of Ben Graham, and he displayed their audited records of performance. So I'm going to link to this article and this lecture from Warren Buffett from Warren Buffett in the description below, but I'm quickly going to walk you through some of the results of these people and hopefully prove to you that, you know, this is doable. Efficient market hypothesis is wrong. The markets are inefficient at times. Generally, they are quite efficient, but emotions can run rampant in the market. We see this with bubbles like the tech bubble in the early 2000s. We saw it in 1929 with the huge bubble and crash after that into a depression. We saw it in 2008 when prices were dramatically less than their values, and you could have thrown a dart at an individual company and made a massive return. So let's get to it. I'm going to quickly run through some investors. So the first one is Walter Schloss. Walter Schloss had a 28.25 year compounded return of 21% a year. The next one is Tweedy Brown. Tweedy Brown had a 15.75 year compounded return of 20%. Warren Buffett, in his original Buffett partnership, had an annual compounded return of 29.5%. The Sequoia Fund, which I believe is Bill Ruane's fund actually, so that Sequoia Fund is the fund that Buffett told his investors to go to when he originally shut down his Buffett partnership. So he basically said, if you want to invest in a mutual fund, go with Sequoia Fund. If not, I'm buying up Berkshire Hathaway stock, go buy it up with me. That's basically what happened. So Sequoia Fund with Bill Ruane returned a compounded annual return of 17.2% per year. Next up, we had Charlie Munger, Warren Buffett's now right-hand man. So he returned an annual average annual compound return 19.8% a year. The Pacific Partners Fund, so this one returned 32.9% per year. Next up we have Pearl Meter Investments. They returned an average of 19% per year. And the list goes on and on and on. So as you can see, these people are massively outperforming the market. They're taking a value investing philosophy. All the monkeys are at the same zoo. Turns out that the monkeys are actually skilled and they know how to flip heads and they know how to flip tails. They know how to do it right. So I'm going to leave this in the description. Like I said, if you enjoyed today's video, be sure to give it a like and subscribe. Drop a comment down below. Go read the article. Let me know what you think. I'm keen to hear you guys' thoughts on it as well. If you're following my channel, I'm assuming that you agree with me and you think modern portfolio theory and efficient market hypothesis is false. But if not, I'm keen to hear your thoughts on why you think that down in the comments below. So that's all for today. If you enjoyed today's video, be sure to hit subscribe, I think over that way, but I might be wrong, and go watch some more videos over that way. Again, I might be wrong, might be the other direction. That's all from me. Cheers.